The ATM warning: how repeated cash withdrawals can lead to account reviews and serious immigration complications. What if I told you that taking out your own money from your own checking account could result in a financial compliance review, temporarily limit your account access, damage your credit standing, and lead to thousands of dollars in legal expenses, even when no criminal conduct is involved? This is not simply a made up scenario. A similar situation reportedly affected a 61-year-old retired engineer living in California during early 2026. He withdrew $9,000 of legally earned savings from a Chase ATM across 1 week in order to pay a kitchen renovation contractor. Less than 2 weeks later, his debit card stopped functioning. Several weeks after that, federal investigators visited his home with copies of his recent banking records. He was never charged with wrongdoing. The matter was eventually resolved, but it still reportedly resulted in thousands of dollars in attorney costs, a reduced credit score, delayed bill payments, and weeks of financial stress for his family. And the banking rules connected to the situation are rules many people have never heard about. Most banks never fully explain them, and many immigrants or permanent residents are unfamiliar with how these reporting systems work until problems begin. Stay with me for the next 12 minutes because I am going to explain 5 hidden financial warning signs connected to common ATM activity, 5 issues that can place cash withdrawals under additional review, and 5 practical steps you can take tonight to better protect yourself, your relatives, and your financial future. The story that reportedly started the investigation. His name was presented as Prep, a 61-year-old Indian green card holder who had lived in the United States since 2011, a retired engineer residing in Fremont, California. He needed $9,000 in cash to pay a contractor renovating his kitchen. According to the story, the contractor offered a discount for cash payment, reducing the total project cost significantly. So Prep did what many ordinary people might do. He visited an ATM, $3,200 on Tuesday, $2,800 on Thursday, $3,000 on Saturday. Total withdrawals, $9,000 within 1 week, all from his own savings account, all reportedly legal funds belonging to him. About 12 days later, he reportedly received a letter from Chase Bank. The subject line referenced an account review and temporary activity hold. His debit card access was restricted. His automatic mortgage payment failed. His wife reportedly could not use the card at the grocery store. Roughly 26 days after the original withdrawal activity, 2 federal investigators visited his home. They were carrying a folder containing several months of transaction records, tax documents, and information connected to ATM locations tied to the account. They reportedly asked whether he was transferring money overseas. He said he was not. He explained that the cash was connected to a kitchen remodeling project. But monitoring systems do not recognize kitchen tiles or renovation details automatically. Compliance software only reviews transaction patterns. The system reportedly detected repeated cash withdrawals, increasing activity frequency, and amounts approaching certain reporting thresholds. According to the story, the account was flagged, a suspicious activity review was generated, and the information moved through multiple federal financial monitoring systems within days. Prep was eventually cleared, but the financial impact remained significant. Thousands of dollars in attorney expenses, late fees, reduced credit standing, and days where his family experienced difficulty accessing normal financial services. His teenage son's college savings account, which shared part of the banking relationship, was reportedly frozen temporarily during the review process. 1 week of ATM withdrawals, 1 automated review system, and an entire household suddenly facing financial disruption. This is why understanding banking compliance rules connected to cash activity matters. And today we are going to discuss many of the systems involved, how the federal government monitors certain financial activity in 2026. In 2026, cash transactions in the United States may be reviewed through several separate compliance systems operating continuously across financial institutions. System 1, the Currency Transaction Report. Under the Bank Secrecy Act of 1970, financial institutions are generally required to file a currency transaction report known as a CTR with the Financial Crimes Enforcement Network, commonly called FinCEN, for qualifying cash transactions above established thresholds in a single business day. These filings are handled automatically by banks as part of federal compliance obligations. Customers are often not directly notified when standard reporting occurs. A report may include identifying information connected to the transaction, including legal name, address, date of birth, and the amount involved. Authorized federal and state agencies can access these records for compliance and investigative purposes. System 2, the Suspicious Activity Report. The suspicious. Federal banking regulations also require banks to file suspicious activity reports, commonly called SARs, when institutions believe transactions may involve unusual financial behavior, possible fraud concerns, or attempts to avoid reporting rules. One important difference between a CTR and a SAR is that banks can review behavior patterns rather than only transaction size. There may not always be a strict minimum dollar amount involved if the institution believes the activity deserves additional attention. Banks are also generally prohibited from informing customers when a SAR has been filed. These reports are handled confidentially within the compliance system. System 3, monitoring connected to certain monetary instruments. Federal rules also require identification verification and record keeping for some cash purchases involving money orders, cashier's checks, traveler's checks, and related financial instruments within certain ranges. These records can remain available for years and may be reviewed by authorized agencies through established legal processes. What changed in 2026? The geographic targeting order. In March 2026, FinCEN expanded a geographic targeting order covering selected money service businesses in parts of Arizona, California, New Mexico, and Texas. The stated purpose was to increase monitoring connected to financial crimes and cartel-related money movement near border regions. In certain designated locations, reporting thresholds for covered transactions at money service businesses were reduced significantly. The listed areas included counties and zip codes in Arizona, New Mexico, Texas, and parts of Southern California. If a person conducted qualifying cash transactions above the applicable threshold at covered money service businesses within these locations, additional reporting requirements could apply. These rules generally applied regardless of citizenship or immigration category because the monitoring systems focus on transaction activity rather than personal background. The 5 financial warning signs connected to cash activity. Warning sign 1, repeated ATM withdrawal patterns. Banks do not only monitor transactions exceeding one large number. Financial institutions operate internal software systems designed to review patterns across accounts over time. The software may evaluate repeated cash withdrawals, unusual frequency increases, or activity patterns approaching reporting thresholds. According to public reporting from former compliance professionals, accounts can be flagged when transaction behavior appears inconsistent with normal historical activity. When Pratt reportedly withdrew $3,200, then $2,800, then $3,000 across several days, the bank's monitoring system did not necessarily view those events separately. Instead, the software reviewed the broader pattern: repeated withdrawals, rising totals, and activity approaching reporting levels. According to the story, the account review process began shortly afterward. Warning sign 2, concerns involving structuring. Under federal law, intentionally breaking transactions into smaller amounts to avoid reporting requirements can create legal problems. The important point many people misunderstand is that investigators may examine intent and transaction behavior patterns, not simply whether a single withdrawal crossed a specific dollar amount. This does not mean ordinary cash withdrawals are illegal. However, repeated withdrawals designed specifically to stay below reporting lines may raise compliance questions. Consider the widely discussed case of a convenience store owner named Ken Kuren from North Carolina. Reports stated that he made regular deposits below reporting thresholds connected to legal business earnings. Authorities later reviewed the activity as possible structuring behavior, and his accounts became involved in civil forfeiture proceedings despite the absence of traditional criminal allegations. Public interest organizations later highlighted the case as an example of how complicated banking compliance rules can affect ordinary business owners who may not fully understand federal reporting standards. Warning sign 3, the lower threshold issue in designated border regions. If you live in or travel through areas covered by geographic targeting orders, the reporting environment around you may operate differently from standard nationwide rules. Cash transactions above lower thresholds at covered money service businesses may generate additional reporting records. This can include certain check cashing services, money orders, currency exchanges, or wire-related activity handled through covered businesses. Someone regularly cashing paychecks through these services in affected areas could generate repeated compliance records over time. Those records may later be reviewed collectively by federal analysts, examining broader patterns. Warning sign 4: information sharing between agencies. Financial compliance reporting and immigration enforcement sometimes intersect through interagency data sharing systems. Public court records and news reporting in recent years described legal disputes involving information sharing agreements between federal agencies connected to tax and financial data. Some federal courts temporarily restricted portions of these arrangements, while legal challenges continued. Critics argued that certain information sharing practices raised privacy concerns, while supporters argued the systems assisted investigations involving fraud and serious criminal activity. The broader point is that financial review systems can sometimes overlap with immigration enforcement processes in ways many families do not expect. Warning sign 5: civil asset forfeiture concerns. Under civil asset forfeiture laws, the government may attempt to seize money or property believed to be connected to unlawful conduct, sometimes even before criminal charges are filed. These cases are handled in civil court and often involve expensive legal battles. Critics of forfeiture practices argue that innocent people can become trapped in lengthy disputes trying to recover legally earned funds. One widely discussed example involved Maryland dairy farmer Randy Sowers. Reports stated that his business deposits remained below reporting thresholds after a teller allegedly suggested smaller deposits would reduce paperwork. Authorities later seized a large portion of the business account during a structuring investigation. The family ultimately accepted a settlement after facing major legal costs. The situation became another national example frequently cited in debates over civil forfeiture reform. The real financial consequences of one problematic withdrawal pattern. Let us look at several realistic examples. Scenario 1: the account review freeze. You withdraw $8,000 across multiple ATM visits within a short period. The bank's monitoring system places the account under compliance review. Temporary restrictions delay access to funds for several weeks. During that period, automatic payments fail. A mortgage payment becomes late. Your credit score drops. Because you are worried about immigration consequences, you hire an attorney experienced in financial compliance matters. Total expenses could reach several $1,000s before the issue is resolved. Scenario 2: repeated activity in a geographic targeting area. You live in a covered California zip code and regularly cash paychecks through a money service business. Over 1 year, numerous compliance records are generated with identifying information attached. Individually, each transaction may be ordinary and lawful, but collectively, they create a detailed financial activity history stored inside federal reporting systems. Scenario 3: civil forfeiture litigation. Your funds become involved in a forfeiture dispute. Legal fees rise rapidly. Proceedings continue for months. During that time, you temporarily lose access to your own money. Bills pile up. Credit damage grows. Family finances suffer while attorneys fight the case in court. Compare those situations with an alternative approach: direct deposit into a checking account. Payments handled electronically through bank transfer, Zelle, or personal check. Fewer cash withdrawals. Fewer compliance concerns connected to large cash movement, the same contractor, the same home renovation, but a very different financial paper trail. Your 5-step protection plan starting tonight. Step 1: avoid creating unusual cash patterns. If you legitimately need a larger amount of cash for a lawful purpose, consider speaking directly with your bank and handling the transaction transparently rather than spreading it across multiple withdrawals. Consistent documentation and clear explanations generally create less confusion than scattered activity patterns that monitoring software may interpret differently. Step 2: reduce unnecessary cash usage for major purchases whenever possible. Use electronic payment methods such as bank transfers, checks, or verified payment applications for contractors, vehicles, or renovations whenever practical. Electronic payments create clearer records showing where the money went and why the transaction occurred. Step 3: understand local reporting environments. If you live in or travel through regions affected by geographic targeting orders, recognize that money service businesses in those areas may follow lower reporting thresholds for certain cash transactions. Whenever possible, use established banking relationships and direct deposit systems rather than relying heavily on check cashing services. Step 4, document major transactions before they occur. Keep invoices, signed contracts, receipts, project estimates, photographs, and communication records connected to large purchases or cash activity. According to the story, Preep's attorney was able to resolve questions more quickly because renovation paperwork and contractor records existed from the beginning. Documentation cannot guarantee protection, but it can help explain legitimate activity if questions arise later. Step 5, seek legal advice before signing important documents under pressure. If investigators or officials present paperwork involving forfeiture, waivers, or consent language, it is generally wise to request legal counsel before signing anything you do not fully understand. Many attorneys recommend staying calm, remaining respectful, and consulting qualified legal representation before making major legal decisions during stressful situations. 5 numbers to remember before you sleep tonight: $10,000, a commonly discussed threshold connected to currency transaction reporting rules for qualifying cash activity; $5,000, a figure often referenced in discussions involving suspicious activity reporting standards, although banks may review activity below that amount depending on patterns and circumstances; $3,000, a key threshold connected to record-keeping requirements for certain monetary instruments purchased with cash; $1,000, a lower threshold applied in some geographic targeting order areas for covered money service business transactions during 2026. 0. There is effectively no guaranteed minimum amount required before a bank may review unusual activity patterns it considers suspicious. 5 numbers, 5 financial warning signs, 5 ways to move through your financial life more carefully and with greater awareness. The family impact that many people never calculate. When Prep's account reportedly faced restrictions, his wife struggled to purchase groceries. Automatic insurance payments failed. Family financial routines were disrupted overnight. His son's education savings reportedly became temporarily inaccessible during the review process. When Ken Curran's business accounts were seized, employees reportedly experienced paycheck delays while legal battles continued. Years of work and savings became tied up in complicated proceedings. When Randy Sowers lost access to business funds, operating his dairy farm became dramatically more difficult while the case moved through the legal system. The true cost of misunderstanding banking compliance rules is not only measured in attorney fees or credit score changes. It can affect groceries, family stability, employees, education plans, and emotional well-being. Every financial record you maintain, every electronic payment you document clearly, and every lawful transaction you organize carefully may help reduce future confusion if questions ever arise. Modern financial monitoring systems are heavily automated. Algorithms review patterns continuously without understanding your personal story, intentions, or family circumstances. That is why financial awareness matters. Protect your finances, protect your family, protect your future, and share this information with someone in your community who may benefit from understanding how cash transaction monitoring systems work in the United States. Many financial experts say the safest approach is understanding how banks normally expect transactions to appear. Sudden changes in behavior, unusually large cash movement, or repeated withdrawals across multiple days may trigger automated reviews even when the money involved is completely legal and properly earned. That is why consistency matters. A person who normally withdraws small amounts but suddenly begins taking out thousands of dollars in repeated transactions may attract more attention from internal monitoring systems than someone whose banking history has remained stable and well documented for years. Context matters, but automated systems do not always understand context immediately. Another important issue is communication with your bank. Many customers avoid speaking directly with financial institutions because they fear questions or delays. But in many situations, proactive communication may actually reduce confusion. If you know you will need a large amount of money for a renovation project, family emergency, medical expense, or legal purchase, speaking with your bank branch beforehand may help establish documentation showing the purpose of the transaction. Financial institutions regularly handle large legitimate withdrawals every day. Problems often begin when patterns appear inconsistent, fragmented, or difficult for automated systems to interpret. Immigrant families and senior citizens are especially vulnerable to misunderstanding these rules because many come from countries where cash transactions are more common in everyday life. In some communities, paying contractors, relatives, or business expenses with physical cash is considered completely normal cultural behavior. But American financial compliance systems are built around electronic record keeping and pattern analysis. Something that feels ordinary to one family may appear unusual inside an automated monitoring environment designed to identify fraud, laundering activity, or reporting avoidance. Consumer advocates have also warned that many ordinary people still do not understand the difference between legal cash usage and activity that appears intentionally structured. Taking out cash is not illegal. Depositing or withdrawing your own money is not illegal. Paying a contractor with cash is not automatically illegal. The concern begins when repeated behavior resembles an effort to avoid reporting systems or hide financial activity. That distinction is critical because misunderstanding it can create unnecessary fear for families trying to manage their finances responsibly. Financial literacy experts frequently encourage households to create a complete documentation trail for important expenses. Keep contracts, save text messages, retain invoices, photograph renovation work, store receipts digitally and physically whenever possible. If questions ever arise months later, having organized records can dramatically reduce confusion and help professionals explain the transaction history clearly. It is also important to understand that not every account review becomes a legal investigation. Many compliance reviews are resolved internally without serious consequences. Banks routinely review unusual activity as part of federal regulations designed to prevent financial crime. The purpose of understanding these systems is not to create panic. The purpose is awareness. Families who understand how reporting systems operate are generally in a better position to avoid unnecessary stress, confusion, and costly misunderstandings. For older immigrants, retirees, and long-term permanent residents, sudden account restrictions can create especially serious hardship because many depend heavily on automatic payments, retirement income deposits, healthcare billing systems, and recurring household expenses. Even a short disruption can affect insurance coverage, prescription payments, housing expenses, and family support obligations overseas. That is why planning ahead matters so much. Another major issue is emotional stress. Families dealing with compliance reviews often describe the experience as frightening because they do not fully understand what is happening or how long it may last. Some become afraid to use their bank accounts normally afterward. Others stop withdrawing cash entirely out of fear. Financial professionals generally recommend staying calm, maintaining organized records, and seeking qualified legal or banking guidance rather than panicking when questions arise. The broader lesson from stories like Prep, Ken Curran, and Randy Sowers is not that ordinary banking activity automatically leads to disaster. The real lesson is that modern financial systems rely heavily on algorithms, compliance software, and transaction pattern analysis that many consumers know very little about. Awareness gives you a better chance to navigate the system safely and confidently. Protect your financial records. Use clear documentation. Avoid confusing cash patterns whenever possible. And make sure the people around you understand these rules too, especially elderly relatives, immigrants, and small business owners who may still rely heavily on physical cash for daily life. This content is provided strictly for educational and informational purposes only. It does not constitute legal, immigration, or financial advice. Always consult a licensed attorney or qualified financial professional regarding your individual circumstances and local laws.